You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. Has the housing bubble popped? Is it in the process of popping now? Is it actually a bunch of several hundred bubbles and they're popping one at a time? Let's get the latest take from our good friend, Wolf Richter. You find him on wolfstreet.com. Wolf, welcome back. So housing, I don't see it weakening too much in places like Florida for the time being, but obviously in less inviting climates like the one you're in, and I don't mean temperature-wise, economic climates like New York and the Midwest, seems the momentum is draining out. Housing stocks are down. What do we make of it all?
Hey, Kerry, thanks for having me back. The whole housing market nationwide is going through a come to Jesus moment because of the mortgage rate. So they're over 5%. They've been over 6% at some point. It's 30-year fixed rate. And so that doesn't sound like a high rate for people that borrowed money in the 1980s, but today's house prices are so much higher that any increase in mortgage rates is going to move layers and layers of potential buyers out of the market. And that's what we're seeing. And it's really kind of across the board, but it's more advanced in some areas, less advanced in others. And we see sporadic, not sporadic, actually, we see widespread drops in asking prices. So that's really started. So they're still above where they were a year ago by a good margin, but they're coming down from these aspirational prices we saw earlier this year and late last year. And so that's one of the first steps. We see volume dropping a whole bunch. We see inventories coming up by a whole bunch. So we're seeing gradually, bit by bit, that this housing market turning around, and the home builders are now in a really sour mood, and foot traffic to their new houses has plunged over the past few months. And so that would show us waning buyer interest. So there's all these things are happening, So if you look at the year-over-year price increases, they're still there. They're still pretty big, but they're coming down. And the last housing bust took many years to work out. And so this is not like watching a crypto chart where hour by hour, we can see the progress. We can't really see the progress in real time like this, but we can see the underlying dynamics, and they're changing dramatically.
Right. Amazing what a 150 basis point increase in rates can do. Yeah,
well, if you can barely make a mortgage payment at 3%, and suddenly you're trying to buy a house at 4.5% or 5% or 6%, it's over. You're not in the market anymore. So that's really what's happening.
It's remarkable when you look at the bust in 08 and 09. All these people, foreclosures, 10 million, 12 million foreclosures across the country. And people nonetheless forget all about that in the past 10, 12 years. Like you said, aspirational, own your own home, key to the American dream and all that. And then they wind up right back where they started from. I wonder what the foreclosure crisis this time is going to look like. You think we're going to have a foreclosure crisis part 2?
Well, foreclosures in the first quarter jumped by a whole bunch, but from near zero last year. So, so percentage-wise, they're up, but they're still near historic record lows. So second quarter foreclosures are going to come out in August. So we'll see that. So I think it's going to move up further, but they're still very, very low. And the reason is that when you have home prices spike like they did, you will not see really a big wave of foreclosures because people can just sell the home and get out of it. and pay off the mortgage and maybe have a lot of cash left over and rent for a while, and without getting the credit damage. Foreclosure become a real issue when home prices drop below where a large number of people bought their homes and they cannot sell them and they cannot get out of the mortgage. And that's what we had last time. And we're not there yet. So people can still sell the house and get at least pretty close to paying off the mortgage, and in most cases, pay off the mortgage in total and just, walk away with a little bit of cash. And so I don't expect to see a foreclosure crisis. I think foreclosures will go back to kind of a normal range. They've been at historic lows, so they're going back up to some kind of a normal range. But for foreclosures to really spike into crisis levels, we would need to see a dramatic drop in home prices across the board, really. And so this may happen eventually, but it's not happening right now. We're seeing the first signs of a turn in the housing market, but we really haven't seen prices plunge. Now, there's another thing I want to throw in. This time around, it's the taxpayer that's on the hook for a large part of the mortgages through the government entities that guarantee these mortgages, or these government-sponsored enterprises. So that's Fannie Mae, Freddie Mac, and then you've got the agencies like the Veterans Administration and Ginnie Mae, and they guarantee mortgages, and so banks don't have them on the books anymore. It's now the taxpayer that's on the hook, and so last time, when the banks were collapsing, the Fed stepped in and to save the banks. Now that's not really an issue anymore. I don't know that the Fed doesn't need to step in. The taxpayer is going to step in and take the loss. So, the Fed can just let it rip and take care of inflation and rather than trying to save a collapse of the financial system, which I don't think that's going to be at risk this time. This is shifted to the taxpayer.
Right. So, this time is different, although what happened, I watched that movie again, Margin Call, and they were sitting with 30 to 60 days worth of paper to repackage and sell to investors. And that 30 to 60 days was basically enough to break all of the investment banks. But now, like you say, the ultimate investor is actually a bank, and the package is backed by the federal government because the federal government is now the guarantor of all Fannie and Freddie and all of those pass-through entities' debts. So I guess it is different this time because, like you say, they'll just add it to the bad student loan debt, and it'll go in a computer in some back room in DC, and nobody will care about it. So have you been watching what's happening with the Chinese real estate market and what they're calling a forced jubilee now, a debtor-induced jubilee, where just millions of debtors have just refused to pay? And I guess China doesn't really have a great foreclosure system set up, a great property distribution system. So they've refused to pay. The banks are going to go bust. The government's going to have to bail them out. And all because they bought into these entities, these new developments that aren't even built yet, and they aren't going to get built. And it's a big mess.
That's probably the understatement of the year, that this is a big mess. Yeah, right now they're looking at $300 billion worth of mortgages that these Chinese investors, and these are investors, they're not trying to buy the home to live in. They're buying apartments in these big developments like other people buy stocks. That's the big thing in China. So this is where their investments go. And so they've handed their money over to these project developers to build these buildings, and the project developers have collapsed, and they're not building the buildings, and they've got the money, and these poor people, they've got, it's like you invested in the stock market and suddenly the stock vanishes before your eyes, Yeah. And this is what they're going through right now. And they can't take possession of anything. They don't have anything, that apartment building has never been built. And maybe there's a hole in the ground, and so they've become investors in this property scheme that they've had going in China for a long time. And that's only one issue, but they have wealth management problems over there, and they have smaller banks up long enough. So this whole property sector, which might be contributing 20% to GDP in China. That is in a slow motion government controlled collapse right now. And the government keeps it from imploding entirely, but that thing is cooked.
Yeah. And, but what I think we're going to see is maybe a global debtor repudiation of debt. All right. Because if they can pull it off in China, what's to stop them from pulling it off anywhere else, Wolf? I mean, this could be a major mega trend of the coming years that nobody out there is seeing.
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, my debt is your asset. So if I refuse to pay for it, your asset goes to zero. And that's how debt always works, is always somebody's asset. The thing in China right now is the government is stepping in with its government-controlled banks. The 4 big banks are government-controlled, and they're trying to get people out of this. They're facing a revolt there, as you said, and so they're trying to solve this somehow through government intervention. And the student loan fiasco in the United States is similar. But as soon as you try, and governments can do a lot of things, but that now we have inflation, we have other issues that limit the debt issuance of government. So when governments issue debt, that's a government debt, but it's your asset. And so it's all tangled up together. And I don't think there is, the whole financial system would collapse if, just in the worst possible way, if we reputed all the debts, because it's everybody's assets. You couldn't, your lights will go out essentially, because, this is a credit-based system and nobody can operate without it. I think we have bankruptcy, in the United States. It's a pretty good way of resolving issues with debt that cannot be paid. And, student loans don't qualify for bankruptcy. So that's why that can't really go through that process. But other debts can go through that process, and eventually they will. And bankruptcy is a reasonably functional way of letting investors eat the losses, and in a way that is somehow enshrined in the bankruptcy code rather than being sort of chaotic and willy-nilly.
Yeah, well, I guess we have a more developed legal system, but the foreclosures in the states that require judicial intervention to effectuate a foreclosure just received an insurmountable really backlog of bankruptcy cases. Places like Florida, New York, New Jersey, all these states, the western states like California, Arizona, many of those states do a deed of trust, and then it's just a trustee sale and there's no judicial intervention required. So if the number of these cases gets too high, bankruptcy can't handle it. Bankruptcy is overwhelmed. When we had 2.5 million bankruptcies a year, the system was totally overwhelmed, and maybe now it could handle it. What's it going to do trying to handle 10 million bankruptcies? It's going to bring it to a grinding halt. So that's where the Jubilee or the legislative solution to what would otherwise be considered a legal problem, that's where that comes in, you know?
Well, if you, like during the financial crisis, people bought a home for $300,000 and they didn't have any money, and then the home price plunged to $200,000 and they were behind on the mortgage, so they stopped making payments. And then there was a foreclosure, and so these people lost their jobs. They don't have any income. They don't have any money in the bank. They don't have no other assets. They already lost a house. So what are you going to go after there? And banks realize that, and creditors realize that in general. It doesn't really, it doesn't really make any sense to chase these people down to where they have to declare, where they have to go for bankruptcy protection because they don't have anything. You're not going to get anything out of them, And I mean, you can garnish their wages maybe, but they don't have a job, so there's nothing to garnish. So, it's at that point when you have these, broke people getting thrown out of a house. You can't really go after anything. It's the lender that loses it. So it just ends there. Just take your loss.
Yeah. Yeah. Well, the first loss is always your best loss. Hey, also, we're looking at automobiles. I know that's your past employment industry. And what we're seeing there is a blip, a rising number of foreclosures, repos, as they call them, in the auto industry. And I was reading an article, I'm sure you saw it too, that a lot of these repos are for sales that took place in 2020 and 2021, whereas normally, according to the experts in the field, the dates are spread out, over a 5-6 year period, which implies that the PPP money ran out and they can't afford these cars anymore.
Well, one thing we have to keep in mind that a repo is the final stage, like the foreclosure on the house, So before you have a repo, you have delinquencies, and delinquencies and repos both were at historic lows last year. So people used their stimulus money to get caught up on their auto loans. And, the foreclosures, the delinquencies on auto loans plunged to just super record lows. And so now this year we've had a little bit of an uptick, but they're really very, very, very low. And, so they're not back to normal levels yet. And it is not, we have a lot of these distortions, because like student loans, all these loans, all the delinquencies were cured either by some kind of forbearance or by getting stimulus money and paying and catching up. And so we have this extraordinary situation last year where there were essentially no delinquencies. And so now they're shooting up, but they're still low. And at this point, I'm not super worried about it. I'm not super worried until I see used vehicle prices drop a whole bunch. They've come down a tiny little bit, but they haven't plunged yet. And when that happens, when used vehicles get to be a lot cheaper suddenly than they were a year ago, then you have a problem that these folks can't get out of their cars. And, a repo means that the lender, not the dealer, but the lender will repossess the vehicle and then sell it at auction. And these people that lose their vehicle, they're going to go out and buy another vehicle. So it's not like they have to drive, they have to go to the grocery store, they have to go to work. So they buy some old car. And so it just changes hands, and it doesn't increase the number of vehicles in the market. And so I don't think that any kind of increase in repos will actually push down prices. We used car market is pretty tight. There's not a lot of inventory. It's not as short as new vehicle inventory, but there is some supply, but it's tight, and there's not a lot of vehicles coming in because of the production problems on the new vehicle side of the last 2 years. So the supply is going to remain constrained, and I don't see prices plunging there anytime soon. So I don't think there's going to be any kind of repo crisis in the vehicle market. I think we're going to see a return to some normal levels from the record low levels last year.
You think? All right. Well, that makes a lot of sense. And the one thing whether it's real estate or automotive, anything where there's money being lent, when you see delinquencies and foreclosures, whatever else is involved, repos at all-time record lows, you know that your peak is pretty close in that market, whether it's housing, autos, anything durable goods, right?
Yeah. I mean, that clearly we've passed the peaks in a lot of places. Like you said, I mean, it's going to be downhill for all kinds of stuff.
Yeah, for lots of stuff, and around the globe too. It's not just an American phenomena. It's an over-indebted world, and the debt's got to go someplace. Like you said, your debt is somebody else's asset. And when your debt becomes worthless, so does their asset. And kicking the can down the road is only going to cause it to be way, way more serious than it would have had we addressed this 40, 50 years ago. But that's for another story. Wolf, hey, we find you at wolfstreet.com. And if you got a question for Wolf, shoot me an email, kl@kerrylutz.com. You'll find the link to his site on the show notes on financialsurvivalnetwork.com. Always a pleasure, Wolf. Thanks for stopping by. Oh, and by the way, sign up for a free newsletter. Wolf, we'll talk to you again real soon.
Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.